Everyone talks about the Magnificent Seven like they're one big expensive group. But what if you look at the numbers right now in 2026? That's simply not true. While Tesla and Microsoft are trading at massive premiums, there is one member of the group that the market is treating like a value stock, and that is Meta. Meta is currently trading at only 20 times forward earnings, making it the least expensive in the bunch by a mile. Today, we're breaking down why the market is terrified of Zuck's $100 billion AI budget and why that fear might be giving us the best entry point in years. Is Meta the ultimate Mag 7 laggard or the biggest steal of 2026? Let's dive in. So let's start by taking a look at the Meta stock chart to give some context to where this stock price has been over the past year. So as you can see, it is only up 4.4% over the past year, which honestly is basically flat. If I looked at this without doing any prior research, I would think that Meta is simply a stalling company. There's not a ton of growth left in the tank for something like Meta, as the market clearly is not pricing that in at any group. Or I would say, it was significantly overvalued, and what we were seeing was a multiple compression to make it the value look better. But what if I told you that Meta was not stalling in growth? It has a 19% revenue CAGR over the past 5 years, at the same time that it's trading at a 21x forward PE ratio, which is absolutely insane and extremely rare, especially for a tech company. So if Meta's fundamentals are so strong, let's take a look at why the stock is bleeding. So since hitting an all-time high of $796 last August, Meta has shed nearly a fifth of its value. To understand why, we have to look at 3 anchors dragging this stock down right now. The first is the capital inferno and margin collapse. First, we have to talk about the capital inferno. Investors have spending trauma from the 2022 metaverse crash, and Mark Zuckerberg just triggered it again. For 2026, Meta has projected a staggering $110 billion in capex. But it's not just the sticker price of the chips. Wall Street is modeling a margin collapse. We're looking at operating margins dropping from a healthy 42% in 2024 down to a projected 36% by the end of the year. Why? Because every time Meta buys a new batch of NVIDIA B200s, the hidden costs start ticking. There's massive depreciation on these chips as they lose value extremely quickly, and that creates permanent drag on P&L. The utility bill, running the world's largest AI clusters, has sent Meta's energy costs into the billions, as well as their structured leases to keep their reported debt low. Meta shifted roughly $30 billion into special lease-style financing, but in early 2026, those bills are finally hitting the balance sheet, and the market doesn't like the lack of transparency. Second, there is a growing fear that we are in a circular AI bubble. The bears argue that Meta is pouring its entire $110 billion operating cash flow into new data centers just to stay relevant, not to actually grow. The market is waiting for the application layer, the actual chatbots and AI features, to prove they can generate new cash flows right now. Meta is spending like a frontier AI lab, but getting paid like a social media company. Until Zuck can show that Meta AI is building new revenue streams, not just optimizing old ads, investors are treating this spending as a bottomless pit. Finally, there's a macro headwind nobody saw coming 2 years ago in 2024 and 2025. Meta's revenue was propped up by an absolute explosion in ad spend from Chinese e-commerce giants like Temu and Shein. But as we hit 2026, new trade tariffs and the removal of the de minimis tax exemption have forced these companies to slash their US marketing budgets. China-based advertisers accounted for over 10% of Meta's total revenue last year. With that engine cooling off, the easy growth for Meta might be officially over. Now that we've taken a look at the massive data center and AI spend for Meta, let's look at the 4 products that they're pushing with it. First is a WhatsApp AI agent, and this is basically an AI chatbot that's going to talk to customers and close sales 24/7 without needing a human call center. Now, they see this doing an estimated $9 billion yearly, and the current run rate, it's growing at 40% year over year, which is extremely quickly. So I guess, as this gets bigger, it'll tend to slow down. So I guess we'll have to see what this is capable of when it starts to mature as a business model a little bit. Next, you have Project Avocado. I like guac. And this is an enterprise software. It's a software as a service, Meta's first closed-sourced high-end model sold as a subscription to businesses for deep data analysis. And that's projected revenue at 10 billion to 15 billion. Now, to be honest with you, with Project Avocado, I don't know that they're going to really be able to penetrate the corporate space, because I really think that Microsoft and Copilot probably have that on lock already. But I'll have to do more research, and we'll have to wait some time to really see how this one plays out. Project Avocado might be better than something Microsoft puts forward, but I don't know if it's going to matter, because Microsoft already has their foot in the door with so many of those companies that will use stuff like that. Next up, AI Studio. And creators can build AI versions of themselves to handle DMs and comments, keeping users on the app longer. I personally don't like this because I think it's very fake. I don't want to talk with an AI bot pretending to be an influencer. I think that's kind of weird. But, they say that it increases in video engagement by 30% on Reels. So I guess that's pretty good. But yeah, this is a little bit too dystopian for me personally. Meta's final AI product, and their highest estimated financial impact product, is the Advantage Plus ad engine. So automated ad machine uses AI to generate images, target customers, and optimize budgets with zero human effort. And the estimated financial impact for this product is 60 billion annualized, which is absolutely astronomical. This is definitely the peak of their products. This thing is gonna do big numbers, as it already has, especially if you can use stuff like AI Studio to create different kinds of content and then utilize Advantage Plus ad engine. You can really be doing some numbers here in-house. Now, the key is to make sure you can replace the Chinese customers that are tending to leave the platforms a little bit. Like, you really want to be able to replace them. But if you can do that, this is a phenomenal product that Meta has. So let's take a look at my bull case here for Meta stock. So Meta represents one of the most powerful AI-driven business models in the global technology landscape. Our bullish thesis is centered on its AI data flywheel, a virtuous cycle where massive infrastructure spending enhances user engagement and ad performance, which in turn fuels the high-growth enterprise AI and messaging segments, creating a compounding and highly profitable revenue engine. So the core ad engine, the foundation of the bull case, is Meta's family of apps: Facebook, Instagram, WhatsApp, which acts as a global high-margin toll booth for digital discovery. So for secular tailwinds in AI ads, transition from manual ad targeting to Advantage AI engine has turned Meta into a performance powerhouse. AI now automates the creative, targeting, and bidding process, driving a significant increase in return on ad spend. The growth is resilient, tied directly to global shift towards AI-optimized commerce. As an AI-driven recommendations, Reels feed improve user time spent increases, this leads to higher inventory and premium prices. Average price per ad, because this revenue is driven by software and silicon rather than human labor, it results in superb operating margins targeting 40+% and massive free cash flow. Our second pillar here is the high growth accelerator, value-added AI and messaging. The true differentiator and primary source of long-term upside is the pivot into business messaging and enterprise AI. Project Avocado, which are expanding rapidly and diversifying Meta's revenue beyond traditional feed ads. For network growth fuels AI data, every single interaction across Meta's 3.5 billion monthly users generates immense amounts of proprietary data. This data is the raw material for AMA4 and beyond. More users and more interactions means more training data, making Meta's AI more human, timely, and valuable than competitors who lack a social graph. Services drive high margin growth. This rich data pool and massive compute moat allows Meta to sell sophisticated solutions back to businesses. WhatsApp Business and AI agents offering AI-powered tools for 24/7 customer service and automated sales. This allows small to medium businesses to run a global storefront without a call center, unlocking a multi-billion-dollar revenue pillar. Project Avocado Enterprise AI, providing a closed-source, high-performance AI model for enterprise clients by charging for API access and specialized intelligence. Meta is evolving from an ad company into a service as a software and AI infrastructure company. For AI Creative Studio, it's delivering back-end tools that allow merchants to generate high-quality video and images ads instantly, farther embedding Meta into the merchant's daily workflow and increasing the switching costs for advertisers. Now, here's the bear case for Meta. While the market is optimistic about Meta's value status, a significant bear case thesis exists. Skeptics argue that Meta is currently trapped in an unsustainable investment cycle where record-breaking spending is masking a structural decline in its core profitability. Our bearish thesis is centered on the capex trap, a cycle where escalating in infrastructure costs and regulatory headwinds outpace the revenue gains from AI, leading to a long-term margin collapse. So the capex black hole, infrastructure is a tax on growth. The foundation of the bear case is that Meta's massive AI spending is not a moat, but an expense necessity just to stay relevant in a fragmented market. The spiral of diminishing returns, Meta has projected 2026 capex to exceed $110 billion, a 70% increase over 2024 levels. Bears argue that the spending is required simply to maintain the current ad business against rivals like TikTok and Alphabet. Instead of driving new growth, this capital is acting as a tax that is crushing the free cash flow and could eventually turn it negative by late 2026. The margin collapse forecast. Unlike the year of efficiency, 2026 is seeing the total expenses grow significantly faster than revenue. Analysts are modeling a sharp drop in operating margins from 42% towards the low 30s, as depreciation from $100 billion chips and soaring energy costs for data centers hit the income statements simultaneously. The second thing is we still have the Reality Labs zombie loss. So the primary source of long-term skepticism is Zuckerberg's refusal to abandon the metaverse, which remains a massive financial anchor on the family of apps engine. Cumulative burn as a red flag, Reality Labs has reportedly over $70 billion in cumulative losses since 2020. The annual losses now exceed $18 billion. Bears see this as key man risk, the reality that Meta's capital allocation is driven by one person's vision rather than the shareholders' return. Opportunity cost of capital. Every dollar spent on unproven metaverse is a dollar not being used for massive stock buybacks or a higher dividend. In a high interest rate environment, the market is less willing to fund a sci-fi project that shows no clear path to breaking even this decade. Now, looking at my portfolio today, I just don't think that Meta really has a place in it. This is a company that I am a little bit scared of the AI spending because there hasn't really been any real returns. And as the CEO of Microsoft said the other day, someone is soon going to have to make a profit from AI to validate the spending. And man, if this spending cannot be validated, then Meta has wasted a ton of money that could have been invested elsewhere or even just returned to shareholders in buybacks. So for that reason, I am going to stay away from Meta for now. Now, if I'm proven wrong down the road and, we see some real returns on this AI investment, then Meta becomes a much more interesting stock. But even as it is now, if you want to get AI exposure, I think something like Google, you're going to be way better off holding Google. I think you could be way better off holding even Amazon. Amazon's not trading at a crazy PE, 33 trailing 12 months. But for now, I just don't think Meta's a great stock. So I'll see you guys later. And in my next video, I'm going to introduce you guys to a brand new holding that I have. So I'll see you then. And I'll tell you right now, it is not Meta. And also, this is not financial advice by any means. This is just my own for entertainment purposes. I hope you enjoy, and I'll see you soon.